Hey everyone, welcome back to Corporate Decoder, the place where we unravel the sometimes boring world of corporate filings. Today, we're diving into a proxy statement. Now, I know what you're thinking. Proxy statement, yawn, but trust me, this one has a few twists, especially if you're interested in how companies play defense with their tax benefits. This filing from Comstock holding companies gives us a sneak peek at their upcoming annual meeting and some pretty important proposals they want their stockholders to vote on. Let's see what's cooking. First up, we have the usual business, electing directors. 2 board members are up for re-election. Christopher Clemente, the company's CEO, and Thomas Holley. Nothing too shocking there. We can also see who is leading which board committee. The audit committee is led by James McCutcheon, and the compensation committee is led by David Guernsey. In the 2024 year, the board of directors met 4 times, while the audit committee met 4 times, and the compensation committee only met once. They are also asking stockholders to approve their independent accounting firm, Grant Thornton, for the upcoming year. A pretty standard procedure, basically asking the investors if they are okay with the people checking the books. Here's a quick look at what they paid Grant Thornton in 2024. A total of $332,700 in audit fees. This compares to 2023 at $290,900 in audit fees, plus $5,000 in other fees. Other fees in 2023 was due to a clerical error, so this looks pretty standard. Next, they're seeking an advisory vote on executive compensation, or say on pay. This is where stockholders get to voice their opinion on how much the top executives are making. It's non-binding, but companies usually listen. There is also another advisory vote, this time about the frequency of advisory votes. Basically, how often do the shareholders want to vote on executive compensation? The board recommends every year, but shareholders can recommend every 2 or 3 years or abstain. Now let's get into the executive compensation. Looking at the summary compensation table for 2024, we see Christopher Clemente, the chairman and CEO, took home about $1.56 million, which includes a $600,000 base salary and a $950,000 bonus. Then we see Christopher Guthrie, CFO, at around $909,000 and Timothy Stephan, COO, at about $1.03 million. But it seems Clemente has a pretty sweet deal. If Comstock terminates him without cause, he gets to continue his current salary for 48 months. That is pretty high. This is the relationship between the pay and performance table. Compensation actually paid to NEOs has increased in line with total shareholder return and higher stock price as of the end of 2024. Now, here's where it gets interesting. Comstock wants to implement something called a Section 382 rights agreement, or a rights agreement. This is a defensive tactic companies use to protect their net operating losses, or NOLs, from being limited if there is a major shift in who owns the company. Think of NOLs as tax deductions that can be used in the future. Comstock has a lot of them, like $111 in state NOL carry forwards. But the government has rules in place that prevent just anyone from buying up a company simply to get their hands on those tax breaks. That's where Section 382 comes in. It says if there's a big change in ownership, more than 50% within 3 years, the amount of NOLs a company can use each year might be limited. So to guard against this, Comstock is proposing a rights agreement. This basically makes it harder for someone to swoop in and buy a large chunk of the company's stock without the board's approval. It issues rights that get triggered if someone gets too close to that 4.95% ownership threshold, making it more expensive for them to acquire the company. But there is a catch here. This rights agreement needs to be approved by the stockholders or it will expire. And because Comstock has 2 classes of stock, Class A and Class B, there's another proposal. Adjust the voting power of Class B shares if these rights become exercisable. This is to keep the balance of power fair. So, they need a majority vote from both stockholders overall and from the Class B stockholders separately to approve this amendment. Now, looking at the largest shareholders, Dwight Shah owns roughly 30% of the Class A stock, while Christopher Clemente owns almost all of the Class B stock. This basically means that one person has the most control. Digging into related transactions, we can see that Comstock has a master asset management agreement with CP, which is controlled by the CEO and his family. There are a number of other agreements with CP for commercial, residential, and parking management. This is something to keep an eye on because those insider relationships can cause conflicts of interest. In fact, there is already one, Investors X, where the company is in a master agreement with CPRS. There are multiple such agreements that might be worth looking into for a more extensive review. Now, what is my take? The Comstock is basically trying to shield its tax assets. These rights agreements are not uncommon, especially in industries with volatile earnings. But investors should carefully consider whether they want to hand over this level of control to the board. But it may also be worth it to take a look at insider agreements and see how the management team is doing. The 1.5 million that the company is generating might be a bit high. Overall, Comstock seems to be taking proactive steps to protect its financial future. But as always, the devil is in the details. Thanks for watching. If you found this breakdown helpful, give us a like, drop a comment and subscribe for more corporate deep dives. Until next time.